We are half an hour away from the open of trading in Hong Kong, Shenzhen and Shanghai. We're watching the China show. I'm Heidi Stroud-Watts in Sydney, along with April Hong in Singapore. Our top stories this hour. Asian stocks track gains on Wall Street as Washington reaches a trade deal with Beijing, codifying the terms of their talks in Geneva. Commerce Secretary Howard Lutnick says the agreement will ensure US access to rare earths from China, the global leader in the industry. And Hong Kong property giant New World Development gets approval from creditors to restructure $11 billion in debt that's been straining its books. Take a look at what we're watching as we get into this final Friday session here in Asia. Pretty optimistic when it comes to broad benchmarks trading at the moment. We do have these consolidated bets of further Fed action and support. In addition, we've had sort of further pressure coming from the narrative from President Trump in terms of pressuring Chair Powell and talking about this idea that perhaps we'll have a sooner than expected time frame in terms of a more dovish replacement. All of this despite, of course, the Fed hawks still really circling to support the patience and caution narrative that we've heard from Fed Chair Powell. At the moment, though, we are seeing Asian stocks climbing. That momentum when it comes to risk appetite is building. A gauge of global equities touching a record high. We saw US stocks also showing that leadership on a record high as well. Some of these calming geopolitical concerns, some calm being restored to oil markets as well, also supporting. And of course, that de-escalation is trade is now where that renewed focus is, particularly with this accord or understanding being signed with China that involves rare earths. A lot of concerns are, of course, over the other trade truces and deals that are still very much on foot. Take a look at what we're watching when it comes to China, though, because we have had a lot of momentum trading when it comes to Chinese and Greater China equities, I should say. The Hang Seng Index's best week since about March. We've also seen that turnover. The volumes are really telling us that perhaps we're seeing this revival of animal spirits in Chinese stocks as well. It's been a spell of low volatility and weak sentiment that could be turning, given that we're seeing the turnover when it comes to mainland stocks the highest since April 10th. That was, if you recall, that sell-off being triggered by US tariffs. And a lot of this coming down to perhaps, if not optimism, at least some calm when it comes to the trade front.
Yeah, a bit of a trade understanding at least. U.S. Commerce Secretary Howard Lutnick says Washington and China have finalized the trade understanding reached last month in Geneva. The deal sets out terms from earlier talks, but still depends on future actions.
So the China deal, we inked the deal. You remember we had a trip to Geneva, and then that was being slow played. We got back together in London, and that deal was signed and sealed 2 days ago.
Our China correspondent Min Lo joins us now, along with our Bloomberg News Desk editor Jill Desis. And Min, let's start off with you. What do we know about this deal? Because it feels a little bit like, London was an extension of the agreement made in Geneva, and now perhaps this deal is a formalisation of what we already knew. Do we have further details or substantive progress?
Yeah, it came as a bit of a surprise overnight when President Trump announced that he had signed a deal with China. But actually, so far, we haven't heard anything from the Chinese side to confirm this. So still waiting for details on that. But Howard Lutnick, Secretary of Commerce, had said that this is basically a codification of the agreements that were made in the Geneva talks and the London talks. We know that for now, tariffs will remain at 55% for China, inclusive of the pre-existing tariffs before Trump's second term. And it will be 10% on the U.S. The two sides had also agreed at the London talks that China will continue to send rare earths to the United States, and Howard Lutnick said that in exchange for that, U.S. will roll back some of these countermeasures. Among them would be rolling back the limitations placed on the export of ethane to China, and that's a chemical that China relies almost exclusively on the U.S. It's critical for plastics manufacturing. Already we are seeing some plastics factories in China really at risk of closure because of this. But aside from ethane, that is just one part of the equation, right? You think about what's top of mind. It's the chip curbs, the chips design software, jet engine parts. Are these going to be part of the deal as well? And we simply don't have the information now.
Yeah, critical sectors that we're watching. But Min, I wonder as well, have you seen recently some signs of goodwill gestures from the Chinese side, including on restrictions on fentanyl? And does that in any way inform whether they will actually deliver these rare earths?
Yes, we did see China quietly added a couple more ingredients of fentanyl into a restricted list. So China is making some effort to try to meet the demands of the U.S. So there is some level of goodwill going on. Although the Middle East conflict threw things into haywire again, China was extremely critical of U.S. actions in the Middle East. But meantime, I think it's quite interesting the timing of this deal actually front-running the other countries. We know that U.S. is still trying to come up with trade deals with all the rest of the world, with the deadline coming up on July 9th, less than 2 weeks from now. But with the Chinese deal, the deadline was in August for the temporary truce to expire, and yet the two countries had gone ahead and signed this deal way ahead of the deadline. So that's really interesting. But you look at how markets has been responding so far, you look at how futures were trading, actually pretty muted, and it shows that if tariffs had ratcheted up in August, that's really going to be a negative surprise. But I think investors are already pricing in the expectation that things are going to remain status quo. And that's what we are hearing now. It doesn't seem like there are huge breakthroughs from this deal. They are just putting into words and codifying whatever they had already agreed on. So not much actually has changed.
Yeah, we'll watch for the China stock market open today. Bloomberg's China correspondent Min Lo for us there. Thanks so much. Now, let's bring in Jill for a look at what else we're seeing in terms of trade deals with other countries. Where does this leave the likes of, outside of China, particularly when it comes to sectoral tariffs, Jill?
Yes, April, I'm glad that you brought up sectoral tariffs because I think that's really the big question mark here that could potentially impact how exactly a lot of other nations, whether that be China, or Japan, India, even the European Union, how exactly they negotiate deals with the United States over the next couple of weeks. It really is that big question. Here's the reason why. So first of all, we're all kind of waiting for this July 9th deadline. That's when, Trump certainly would like a lot resolved on the reciprocal tariff front. Remember, that's his big Liberation Day tariffs. He gave everybody 90 days to negotiate new deals. We've heard just recently from Howard Lutnick, talking about how they want to divide countries into various buckets as they start to resolve those deals. The issue is that sort of parallel with those reciprocal tariffs, remember, those are the tariffs that were country by country that Trump really handed down via executive order. Parallel to that, obviously, we've got these reciprocal tariffs. These sectoral tariffs, ones that have already, been in effect, looking at steel and aluminum, auto parts, that kind of thing, and along with some others that could potentially still come into effect. The U.S. Commerce Department is investigating potential sectoral tariffs on everything from semiconductor parts to pharmaceuticals and such. So that kind of is still looming there. I think there's also just the sort of conventional wisdom that anything that's implied under the sectoral tariffs, Section 232 is really that part of U.S. law that would apply under, may be much more difficult to challenge or repeal domestically compared to, say, the Trump executive order tariffs, which I think are still a bit up in the air. So if you're any of these countries, if you're India, if you're Japan, if you're the EU, if you're Vietnam, I'm not really sure what motivation you have to actually negotiate something with the Trump administration ahead of that July 9th deadline, if there's this fear that you could be giving away a lot of your leverage, a lot of your negotiation power, signing something that's this deal, and then you've got other sectoral tariffs that come into effect. I just want to give you one example here. There's a lot of questions over that UK partial deal that was signed, just a bit ago, because the UK kind of comes in, they make a deal with Donald Trump. They're still subject to some of those big steel tariffs that are come under that sectoral angle here. So I think, big picture here is that there's a lot of confusion over, as we ramp up to that July 9th reciprocal tariff deadline, how exactly these countries are going to play ball when you've got, that looming threat of other industrial tariffs that could be hanging over them still.
And it is that clustering of confusion and different trade jostling right as we head towards that deadline. Indian negotiators are actually in the US at the moment. And to your point, there is a sense that India is, amongst other parties, kind of digging their heels in.
Yes, I think that when you look particularly at some of those really key U.S. allies, I think some of whom were wondering, why they were hit so hard with some of these reciprocal tariffs in the first place. I mean, India, Japan also, I think, is a really interesting one to watch. Obviously, you've got India on the ground trying to make a deal there. I think Japan is also interesting because obviously a lot of those auto sector tariffs are really, really hitting, potentially Japan there. I think a lot of, Japanese automakers, manufacturers are really, really concerned when it comes to their. It just really does leave a lot of questions as to what these deals are ultimately going to be. If you're India, obviously, you want to make a deal. You want to, be able to, get to a good place with the Trump administration. But when you've got the potential for more tariffs down the line after you've already got something done and dusted that could be coming to bite you, I think that makes negotiations very difficult.
Bloomberg editorial data there in Hong Kong, and we are counting down to the open of trade in Shanghai, Shenzhen and Hong Kong, as well as we see really investors are digesting this deal that has been signed between the US and China. This on the back of a pretty good run when it comes to risk sentiment in Chinese equities. This is the China Show.
And if we had a person over at the Fed that would lower interest rates a little bit, that would be helpful too. It's hard to believe. This is on top of, we have to fight this guy. He's not doing the job. Each point that he keeps it up is the equivalent of $300 billion. $300 billion. So if he lowered it to, it would save $600 billion.
President Trump there speaking at the White House earlier, putting pressure, more pressure that is, on Fed Chair Jay Powell to cut rates. Let's bring in now with some analysis Jenny Zeng, who's the Deputy Head of Fixed Income and APAC Fixed Income CIO at Allianz Global Investors. Jenny, great to have you with us. So really further piling on the pressure for Chair Powell on his part refusing to cave to that pressure, right? And even as sort of, the dovish candidates are circling him, we're seeing that support from his fellow hawks, from Thomas Barkin to Mary Daly to Susan Collins, all kind of reiterating this path of patience going forward. Do you think that political kind of spectacle changes the risk when it comes to that rate path and inflation path forward?
The Fed rate cut actually is at the core of a fixed income market right now. Now, if you look at the U.S. economy, the current status of the U.S. economy is showing that hard data, including the job unemployment rate, actually is softening, but it's not showing any imbalances. So it's resilient, but it's softening, it's moderating. And while at the same time, in fact, soft data, including consumer spending numbers, are improving significantly, in fact. Now, there's only one very strong reason for Fed. If they're going to cut earlier than the market expected, then it will be the inflation data, the very recent inflation data. CPI and the PPI actually has been surprised on the downside for 4th months in a row. So that will give Fed some excuse to cut if you really want to cut. But we really think that the Fed is going to be in a wait and see mode for the foreseeable future. And we really don't think Fed is going to cut in July. Now, again, we really think Fed needs to see a significant weakening of the growth numbers and the job numbers for them to cut. Then that will be towards the end of the year.
Jenny, does that suggest that you think that the gains that we're seeing in treasuries for, I think, a third week now, the sort of structural weakness that we see in the dollar might be overdone at this point?
The interesting thing is, we can talk about the potential path for both growth and inflation. One of the challenges nowadays in the market is that the visibility for near-term number, in fact, is quite low, particularly on the inflation side. I think on the growth side, we can have a little bit more visibility and a conviction that seeing that growth is slowing down. But on the inflation side, given that the inaccessible, it's very difficult to analyze the inflation impact, particularly from tax tariffs, and we don't know. We don't even know what's going to happen in July the 9th, and we don't know what's going to happen in August. So inflation assessment is increasingly more challenging. So as a result, if you look at the Treasury market overnight performance, you can see it's rallied, yes, but also steepened. That reflects a few things. Number one, of course, it's reflecting the weaker data, and then number two is to reflect that concerns the investors' concerns on the potential decline of independence of Fed.
Yeah, Fred, credibility really in focus here. I wonder what this means about the de-dollarization theme, what this means for investment flows into Asia.
Yeah, de-dollarization or not, if we look at the U.S. dollar as a currency, on a PPP basis, despite the recent decline, it's not even that cheap. So cyclically, we could even see more pressure on weaker dollar. Structurally, then that actually fits into the structural thing that people are looking for diversification, particularly in Asian countries. What sets Asian apart is that Asian actually is the world creditor. So Asian has a lot of money, a lot of excess savings that invest in U.S. dollar assets. Now Asian countries are looking for diversification. And then we see the first rounds of reallocation of capital. That could slow down a little bit going into the summer, but may resume again once we started to see weakening of U.S. growth numbers and maybe even a pickup of inflation. Then that will strengthen, reinforce that structurally weaker dollar narrative.
And it also, I think, enhances the appeal of the yuan. At Lu Jiazui, there was a lot of talk about yuan internationalization. Jenny, what do you think is the best way to capitalize on that trend?
Absolutely right. With people started to reassess the dominance of U.S. dollar, and in Asia there is a natural potential alternative, which is yuan and RMB. And if we look at the past decade, the CGB performance actually outperformed both U.S. Treasury and the German bond by a large margin. That increased the credibility of CGB as a potential alternative as a safe haven assets. Now, if you look at what happened recently, I do think that the China is also taking the opportunity of a weaker dollar trend to further liberate its capital account, evidenced by the most recent announcement of the Payment Connect program last Friday. I think it was announced last Friday.
Jenny, just wondering as well, when it comes to CGBs, how do you think the PBOC is thinking about yields? Because it's been relatively range-bound of late.
Yes. So China's overall yield level, it also depends, at the end of the day, it still depends on growth and inflation. Well, with all the tech talks, which are all good news, in fact, the economy still struggles. And the government is not able to reflate the economy as what they wanted at the beginning of the year. So we expect even more fiscal spending, fiscal stimulus to come, probably in the July Politburo meeting. So which means you still have a deflationary pressure in the economy, and you can see that the growth number continue to be moderating as well, particularly if we do not see a continuous stabilization of the property market that would put even more pressure on the growth perspective of the economy. All that points to a lower yield from a 6 to 9 months perspective. Now, the thing is, from a central bank's perspective, you do not want to see yield coming down too fast, like what we see in fourth quarter last year. You want to see that the yield grinding down slowly so as to support the economy. So we think that CGB yield will continue to go down. Yeah.
Yeah, the refreshed steepening in treasuries, how frustrating is that, particularly when it comes to the longer end of JGBs?
The JGBs, sorry.
Yeah, so there would have been some hope for curve flattening. That's clearly not what we're seeing when it comes to treasuries. Does that mean that we're not going to see much love for the longer end for JGBs going forward?
Yeah, it's interesting you mentioned that. In fact, in our view, in most of the parts of the world and the fixed income market, we think a steepener is a clearer way of expressing a duration view. If you think about the U.S., having said that, that lower end is driven by Fed cut, and we started to see weakening of economic data, while the longer end is more driven by the fiscal concerns and also the concerns on the independence and the credibility of Fed. So it's actually easier to play that as a steepener curve. It's the same for JGB. Now, there's only one market, very interesting, and there's only one market which is different, which is the CGB market. And we see CGB market actually flattened compared with all the steepener trend that we've seen in the other global fixed income market, which is very interesting.
All part of investors looking for alternatives outside of the U.S. Jenny, great to have you with us. Thanks so much. Jenny Zeng, Deputy Head of Fixed Income and APAC Fixed Income CIO at Allianz Global Investors. Let's take a look at how Chinese markets are shaping up. Of course, the one stock that we're keeping a close watch on is Xiaomi after its new SUV models got really strong pre-orders within minutes of the launch. So we're indicated higher 8% in Xiaomi. Other than that, looking like a mixed start to both Hong Kong and Chinese trading. Watching out for dollar China as well. It's overall been nudging lower. Plenty more ahead. This is Bloomberg. You're watching The China Show. A couple of stocks that are in focus, including Xiaomi, after it released its latest SUV model. Of course, this is a company that's been breaking into the EV space, and we already saw how stocks were near that record high. I think this 8% climb at the open would take it to that level. Certainly, this is against the backdrop of the pre-orders for the YU7 coming in strong, I think stronger than some estimates, 200,000 orders within minutes of its release. Other than that, keeping an eye on New World as well, as we're hearing that it's secured 100% approval from all banks for an $11.1 billion loan refinancing. That's according to Bloomberg sources. And this really caps, I think, a month-long negotiation for a debt package. So seeing it higher as well, Heidi.
Take a look at what we're watching pre-market. Of course, we've seen quite the run when it comes to the Hang Seng Index, the best week since about March. We'll be watching to see if that momentum can be sustained, particularly now that we've had this trade deal being secured or trade understanding being secured that removes potentially some of that volatility. This is what China futures will firmly trading to the upside. Also watching that dynamic of yuan strength and Hong Kong dollar weakness. Welcome back. You're watching The China Show. We are counting down to the open of markets across Greater China. We're expecting that upward momentum given that US stocks continue to trade at those record highs overnight. Global equities also touching a record high. This as a renewed focus away from calming geopolitics in the Middle East returns to the bread and butter for these markets of trade as well as the Fed. The momentum when it comes to Fed rate cut expectations is building. We're also seeing that pressure from President Trump, the political pressure from government on the Fed chair Powell as well as the Fed really building there as well. We'll talk about an earlier than expected selection of his replacement. All of this feeding through to quite a bit of optimism when it comes to risk sentiment, particularly as we have seen the best month for the Hong Kong Hang Seng Index since about March. So, April, just take a look at what we're seeing at the moment at the open.
Yeah, I mean, as you say, it's some of that trade optimism, and for Chinese markets also that optimism that authorities will continue supporting the tech sector. We've seen mainland markets doing fairly well. They hit it for the best week since early March, and some of the bullish indicators include the finance stocks that have been outperforming. Flip the board. Aside from that, we also saw the Hang Seng. I think it's on track as well for its best week since March. And if you can take a look at this next page, we'll show you as well what we're seeing in terms of dollar China, in terms of how the PBOC has kind of been guiding the renminbi and supportive of that gradual strength against the backdrop of dollar weakness. But of course, the stocks that we are watching today would include the likes of Xiaomi after its SUV launch, but also New World development, some signs that that debt package is well underway. Aside from that, with geopolitics in the mix and rare earths, in focus, given what was eked out between the U.S. and China based on the trade understanding. Let's flip the board and take a look at how they are faring as well. Of course, this has been a key focus, whether China is going to be delivering these rare earths that the U.S. sees as absolutely critical, seeing some upside when it comes to some of these rare earth stocks. Heidi.
Take a look at how markets are doing with a little bit more detail. Equities reporter April Ma joins us now from Hong Kong. So do we see this sort of sustained momentum at this point? And what are the catalysts for the next move higher or potentially a little bit of a retracement?
Yeah, I think we've definitely seen a huge difference from the days, the past couple of months, really, because now the lead gainers are those high beta names like defense, like securities companies, and of course today Xiaomi, which will inevitably bring up those names that have been on the auto supply chain that have been dormant for a couple of weeks now. So I think momentum is back. We've seen that in the pickup in turnover. Some of the worrying signs, though, is the fact that margin trades have not picked up. So it feels like the animal spirits are they're back, but not completely back. So I think the market momentum, in order to sustain, we'd have to see a lot more policy catalysts. I think what investors are talking about now, apart from the Politburo, which is late July, I think we also want to see a more of those birth subsidies as well.
Aside from maybe some support from authorities, what are you seeing in terms of valuations and the likes of Xiaomi, record highs, right? You know, that sense that maybe there's too much into this.
Yeah, so I think with the huge beat in the pre-orders last night, I think investors are also taking it with a grain of salt, because a lot of these orders are converted from the SU7 orders, and also there's a lot of scalpers out there. So I'm not sure, or at least the people that I'm talking to are not completely sure that we can take that number at face value. But then also, on the other hand, there's a lot more reason to be optimistic, because this latest model shows that its foray into the high-end end of electric vehicles is now accelerating.
Bloomberg's China equities reporter April Ma there with the details. We are also getting a little bit more of a read when it comes to the broader economic outlook and how the economy is faring at the moment. Industrial profits for China just crossing the Bloomberg year to date. That year-on-year number for May seeing a contraction of 1.1%. Expectations were for a pretty meager gain of 1%, and it certainly reverses the gains that we saw in April of close to 1.5%. Year-on-year, that reading is a contraction of 9.1%, also reversing the gains of 3% that we saw in the previous month. So overall, that downside pressure when it comes to the broader Chinese economy continues, even as we see perhaps a little bit more progress on the external trade front.
Yeah, the macro backdrop does still continue to worry. We're seeing that weakening on the Chinese yuan as well. Against the backdrop of this data. But in the meantime, Bloomberg's learned that Hong Kong-based builder New World Development has secured written commitments from all the banks involved in its $11 billion loan refinancing. Our China credit reporter Trista Sinyi-Luo joins us now. So Trista, we're getting a sort of update from Bloomberg sources. What does this all mean for the builder?
Yeah, I think it means like we are one step closer for the builder to finalize deal. The builder has been spent the past couple months on this mega refinancing discussion, and right now there's just some paperwork done, and we're expecting that they will come soon. So it's actually good news for New World.
How significant is this mega refinancing then?
Yeah, I think this mega refinancing is crucial for New World, as it will buy them some time. Once it completes, some borrowing that are supposed to be due this year and next year will be pushed back to 2028, which means that New World can still have some breathing room to try to improve their financial situation. But we need to remember that New World still has the highest debt burden among all Hong Kong developers here, and is still grappling with over 200 billion Hong Kong dollar of liability.
Yeah, so it's not quite out of the woods yet. I mean, what are we expecting in terms of coupon payments, for example? What should people watch out next?
Yeah, I think as for coupon payment, I think investors are largely expected that should be okay. But I think right now the attention has shifted to whether New World can close a new loan, which they're using is Crown asset Victoria Dockside as the collateral and trying to raise 15.6 billion Hong Kong dollar. I think investors are keen to see whether that deal could be closed. And we reported earlier that part of the proceeds will be used to repay the complete refinance. I think another thing investors are looking is whether the builder will do liability management exercise on its dollar bonds. We haven't seen any sign yet, but I think some bondholders are thinking maybe it's time for the company to talk with them right now.
Are there any implications for the broader Hong Kong market?
I think for New World, it's more exceptional as standalone case, although we know that the Hong Kong property market is still not good, especially on the commercial real estate side. But when you look at New World's major rival in Hong Kong, I think they're in a better position with less debt burden.
Bloomberg's China credit reporter Trista Xinyi Luo there. Well, New World is also the focus for the Bloomberg Originals team this week as they shine a light on the Hong Kong family dynasty grappling with debt and China's property crisis. You can watch that full documentary coming up on The China Show, or subscribers can watch anytime on the terminal or at Bloomberg.com.
Yeah, Heidi, in the meantime, let's recap some of the lines that have been coming out from the SoftBank CEO who's been speaking to shareholders in Tokyo, saying that the company exists to realize artificial super intelligence. And certainly they've had a sort of mixed performance when it comes to some of its AI bets in the past couple of years. Recently, it's sort of seen as turned a corner. So Masayoshi Son really indicating that optimism surrounding some of the investments into artificial intelligence. Plenty more ahead. This is Bloomberg. You're watching The China Show, and of course it's all about the geopolitical backdrop. A Goldman Sachs Asia-Pacific executive says uncertainty over U.S.-China trade tensions looks set to run for some time despite the recent tariff truce. Kevin Sneader also told us what he thinks Beijing needs to do to get foreign money flowing again as investors look beyond the U.S.
I think we're really debating what happens to the incremental dollar. And you start to think about new money. Where's that going to go? And I think when you think about it that way, then there is definitely more interest in looking at places beyond the US. And that money may go to China, but there's a high bar in it going to China. And the bar is one of the talks remain very positive. I was at the WEF in Tianjin, and we heard a lot of statements that would give one encouragement around consumption, the importance of consumption, the desire to keep reform and continue on the journey. Lots of reasons to have hope, but fundamentally investors want to have three things: the consistency of policy, clarity of direction, and transparency around progress. And I think once those three things line up, more money will return, I suspect, to China in volume. But at the moment, we're still in the wait and show it to me phase.
And tariffs. How concerned are you about tariffs? And we're just about close to that July deadline for many of these countries in Asia, and how they deal with the U.S. now.
Well, isn't it remarkable that despite the fact the tariff deadline is nearing, you look at the markets and you see them continuing in a very positive stance? That may be a place where we could all regret the fact there hasn't been enough attention on the less than 2 weeks that there is between now and July 9th. And I think the reality is there's a lot of questions on tariffs. There's a lot. At one moment you think it's quieting down, but then you remind yourself at this moment in time there's a framework agreement and a deal with the UK, but beyond that there's not a lot.
Yeah.
That will change, or I suspect that will change, but it means that the uncertainty, are we past peak uncertainty on tariffs? I'm not so sure. And yet many people have put it in the rear view mirror. I think in truth on tariffs we won't know until we get the latest messaging around what is being expected of different geographies. And it's only once we know that. I think one thing we do know is that with regard to the big bogey, which is China, and the China-US discussion on tariffs, August 12th would be the 90 days there, that one looks like it's going to run for quite some time. And I suspect we're going to see that really be a long process. And it's only once that process is underway we'll get a sense of, is it going to be something akin to what we saw in the phase one tariff discussions and agreements back in 2018-19, or is it going to be something more abrupt?
Goldman Sachs Asia Pacific ex-Japan President Kevin Sneader there speaking to our colleague Yvonne at the Bloomberg Sell-Side Forum in Hong Kong. Let's take a look at some of the corporate stories that we're following this hour and looking at Nike supplies in Asia today after the apparel maker's shares popped after hours thanks to a brighter outlook, hinting that CEO's Elliott Hill's turnaround plan is starting to work. Sales are still expected to dip this quarter, but not as much as before. Hill says it's time to turn the page with better earnings ahead. Nike's also tackling about $1 billion in expected tariff costs by raising some prices and cutting back on manufacturing in China. The Chinese smartphone maker Xiaomi has launched a $35,000 SUV that aims to take on Tesla's Model Y in China. The company says it got over 289,000 pre-orders for the U7 within an hour. The new model will be a key test of demand for Xiaomi cars after a fatal crash involving an SU7 sedan sparked scrutiny from Chinese authorities and hammered orders. Plenty more ahead. This is Bloomberg. Japanese chip gear maker Tokyo Electron says it's on course to widen its lead against Chinese rivals despite the billions of dollars Beijing is mobilizing to catch up. We spoke exclusively with the CEO, Toshiki Kawai, and asked where he's seeing those opportunities in fast-moving technological development.
Until recently, it was around 45%, so nearly half. Investment in other regions aside from China will grow, so the ratio of China's sales to total sales will inevitably decline. About 35 years ago, China's sales ratio was around 30%, and I expect it to settle at around that level.
How long do you think it will take for Chinese equipment makers to catch up when it comes to technological advances to become a real competition to the likes of Tokyo Electron?
Actually, there is a gap with China's technology. I think it's possible to maintain the difference in technology between China and our company. I'm sure that Chinese vendors are trying to catch up with us, but we must be faster. We can be faster than them in technology innovation, and that's how we can maintain or increase the difference. We are the SPE manufacturer, but we are not chip makers. So, for us, it is key to work with the world-leading chip manufacturer to develop the best-in-the-world process and best-in-the-world equipment. The pace of technological innovation is likely to accelerate. I believe this gap will continue to widen. Tokyo Electron is always pursuing the latest cutting-edge technology, so we believe there will be no issues with our growth.
What happens if the needs of the customers change? Because this year we saw the changes brought from DeepSeek with cheaper models, more efficient models that perhaps might need less hardware. Will that change your calculation going forward when it comes to what's needed for the next generation of advances for artificial intelligence?
The emergence of various AI solutions means there is potential for many applications, and the number of applications will increase. As a result, we can expect the overall use of semiconductors to expand. At the same time, the common global goal is finding a balance between digital transformation and green transformation. This will require technological innovations in semiconductors. With increasing applications, there will also be a demand for high capacity, high speed, high reliability, and low power consumption. This has been a constant necessity since the invention of the transistor radio 76 years ago. This pursuit of technological innovation will continue. Even as various AI solutions emerge, the demands don't change. I believe that the devices themselves will continue to expand.
How has the ongoing trade war and the uncertainty over tariffs affected your business and how you're preparing right now?
At this moment, tariffs are not applied to semiconductors. For example, if we look at Tokyo Electron's sales this year, the United States market accounts for 8%. Considering that tariffs are not currently in place and that the sales share is 8%, we believe the short-term impact of tariffs will be limited and minimal. But we need to continue monitoring developments. We have to watch the progress of tariffs. Our value lies in how we improve and enhance productivity, cutting-edge technology solutions, and productivity enhancement. We will discuss with our American customers and partners how to create solutions that go beyond these tariffs. We also see this as a business opportunity.
Tokyo Electron President and CEO Toshiki Kawai speaking exclusively with Bloomberg's Sherry An. Meantime, China's former Deputy PBOC Governor Zhu Min says the country's AI advancements are about to unleash a wave of more than 100 DeepSeek-like breakthroughs in the coming 18 months. Our chief North Asia correspondent, Stephen Engel, gives us a closer look at the country's progress in humanoid robotics, also known as embodied or physical AI.
Embodied AI is all the rage in China, from industrial automation to autonomous EVs, from delivery drones to increasingly advanced robotic humanoids and pets. AI is on board, and with their sensors, motors, and natural language processing, they're interacting with us and the rest of the physical world, and it's arriving in much more lifelike packaging, as creepy as that may be. China's Ministry of Industry and Information Technology says China since last year has produced nearly 100 embodied AI robotic products, claiming the country holds 70% of the global market, due largely to its unrivaled stem-to-stern supply chain of critical parts and advancements in its own AI and chips. The embodiment, if you will, of China's DeepSeek moment.
I think that ushered in a whole corporate culture where we're trying many Gen AI use cases. We have all sorts of labs and PhDs who are working on these things. When would this ever impact the bottom line or have real impact? I think that's the question.
We do know that the central government has put out a venture fund tapping about $138 billion for the development of humanoid robots for industry and for personal use. That is a lot of money and probably just the tip of the iceberg. In an otherwise difficult job market in China, online recruitment firm Zhaopin says the number of job openings in China's humanoid robotics sector has quadrupled so far this year from last, with salaries for the needed algorithm engineers rising well past the average urban pay. Hangzhou-based Unitree is one of the pioneers of consumer robotics in China, offering its latest so-called humanoid agent AI avatar, the 4-foot, 2-inch, 77-pound G1, on the web for $16,000. He can do all kinds of things. He can run, he can jump, he can get you coffee. Or for $1,600, there's the 4D ultra-wide recognition LiDAR-equipped Go-To dog, with plenty of tricks up its 12 flexible knee joint motors.
It can stand. It's just the beginning stage.
For China's vast industrial complex as well, rapid automation includes the increasing use of inspection and diagnostic bots with embodied AI, such as Lenovo's six-legged Daystar, deployed in places unreachable by or unsafe for humans.
I think the Chinese robots will come into the world, in a way that as a price for money and price of value, that will be quite unbeatable.
With the backing of state policy and funds, expect a myriad of new embodied AI products to try and grab your attention. Like it or not, we may be staring directly into the future. Stephen Engel, Bloomberg News, Shanghai.
And we'll be hosting a live Q&A with Bloomberg experts on the race for AI supremacy. You can listen in on Bloomberg.com/Q&A. Subscribers can post their own questions at 10 a.m. Hong Kong time. Let's get you a quick look at the markets and how we're tracking this Friday, given what was really a pretty exuberant handover overnight, with global equities touching that record high, US equities continuing to sustain that momentum as well as these Fed cut bets continue to build. The pressure on the Fed also continues to build as well from President Trump, and all of this kind of adding up to a more dovish set of expectations. We're watching some of these names that are trading at the moment, including China Renaissance is the stock that is trading up by 33% at the moment as we continue to watch really this continued rally. Also quite a bit of rally when it comes to these on-a-device related stocks there as well, after progress being made on the IPO. Some of those names seeing some more modest gains there, companies that have invested in or have business relations with the smartphone maker On-a-Device. The firm resubmitted that pre-listing tutoring application with the regulator. Lots more to come in the next hour of the China Show. This is Bloomberg.
Welcome back to the China Show. Here's a look at the HSI half hour into the session. We're seeing it firm, and some of the big gainers include the likes of Xiaomi, financial-related stocks, and chip makers. Of course, the backdrop looks like it's improving, given how some of these geopolitical tensions have been easing. Heidi?
Yep, and as a result of that, global equities are on the cusp of another record high, and Asia is certainly planning into that broader rally. This is what we're seeing when it comes to trading across Greater China, as you touched upon, but also seeing some gains across other major markets, including Japan as well as Australia as well. These are some of the movers that we're watching in terms of some of the tech-related names. Tokyo Electron is up by just about 5.4% there. We're also seeing some of the chip names seeing a boost there as well. And overall, a lot of these are sort of, in line with some of the calming geopolitical contentions that you talk about, particularly as we hear news of that signed deal between the US and China. At the moment, across the region, we're seeing broad upside for the MSCI Asia Pacific. Australian stocks are testing all-time highs again. Mining shares are really dominating there. Japanese stocks there accelerating for a fourth day. A lot of the AI-related and tech-related names are boosting those gains. It's very interesting watching the dynamic when it comes to the Kospi. It is sort of the outlier in terms of underperformance, but analysts thinking that's more a little bit of profit taking given the massive gains we've seen in Korean equities rather than a loss of conviction. That index, the Kospi that is, has climbed around 15% in June alone. So perhaps unsurprising that we're seeing a little bit of a cooling today overall.
Yeah, but as we alluded to earlier, it's really the sign of trade understanding between the U.S. and China, with the U.S. Commerce Secretary Howard Lutnick saying a trade understanding with the China has been signed based on the framework agreement reached last month in Geneva. China correspondent Min Min Lo joins us now from Hong Kong. So Min Min, what else do we know about this deal? Can we even call it a deal?
Well, President Trump is calling it a deal, but we really don't have a lot of information how detailed, how comprehensive it is. All we know is what Howard Lutnick has said. He says that this is a codification of whatever had been agreed upon in the Geneva and the London talks, which means that China is going to continue to supply rare earths to the United States. That seems to be the main thing that U.S. is really hung up upon. And in exchange, the U.S. will agree to roll back some of these countermeasures. Howard Lutnick mentioned in particular rolling back the curbs on ethane, which is a chemical that is critical for plastics manufacturing, something that China relies almost exclusively on the U.S. on. But he didn't really talk about the other big sticking points that China is concerned about, especially when it comes to the chip curbs, the curbs on chip design software, jet engine parts. No mention of these. And more critically, we haven't heard anything from the Chinese side as well. No confirmation yet as to whether or not this deal is signed. But have a listen to what Howard Lutnick had said in an interview with Bloomberg.
So the China deal, we inked the deal. You remember we had a trip to Geneva, and then that was being slow played. We got back together in London, and that deal was signed and sealed 2 days ago. President just said it just the other, I don't know, 15 minutes ago. And then he also suggested that we are, of course, at the very close finish line with India. Of course, the way these deals happen is their prime minister and their parliament have to approve it, and the president likes to close these deals himself. I mean, he's the deal maker. He loves to close it. I think we have deal after deal after deal. The president's going to make his calls. He's going to decide exactly the finishing touches on them. And then what we're going to do is we're going to lay out a structure of all the different kinds of tariff arrangements with different countries, right? There are countries with huge deficits. There are countries that are balanced. We're going to set that all up and get that ready for July 9th.
So it sounds to me, Secretary, and correct me if I'm wrong, as I listen to you, that we either get 88 deals announced in the next 2 weeks, or there's going to be action one way or the other by this administration that July 9th will be conclusive. If there's no deal, here's the new reciprocal tariff. Is that right?
Of course. So what we're going to do is we'll announce some deals, but basically the deals we're going to announce are sort of the head of the class, the structural spot in the line, and then all the other countries will fit behind those categories, right? So we're going to do top 10 deals, put them in the right category, and then these other countries will fit behind. So you'll have South American deals and you'll have African deals. You'll have it all structured and set up, and that's the model how you do leadership, and we will put these people in their proper buckets on July 9th. So those who have deals will have deals, and everybody else who's been negotiating with us, they'll get a response from us, and then they'll go into that package, and July 9th will go forward. And as the president said, if people want to come back and negotiate further, they're entitled to, but that tariff rate will be set, and off we'll go.
So it's interesting, you heard Howard Lutnick there saying it seems like the White House is really busy coming up with these deals, especially the top 10 major deals that will form a template for all the other countries. But then the US-China deal seems like already a done deal, front-running the other countries, in fact, way ahead of that August deadline when the temporary truce is supposed to expire. But of course, the question then is it going to be something that is truly sustainable? Because we have seen so many examples of it in the past, right, of agreements being made and then things kind of backtracking, and then the two sides come to negotiations again just to go back to the same starting point. So we kind of are moving to nowhere. Even as we sign this deal, it is in some ways a status quo of whatever had been agreed upon in the Geneva talks. So we'll have to see, especially what China has to say about this deal. I think that's going to be very critical.
Bloomberg China correspondent Min Lo there with the latest. Well, still ahead on the China Show, we'll be speaking with the co-founder of PriceStats on the impact of Trump's tariffs and how that could influence the Fed.
Meanwhile, the White House says there is no decision imminent on the next Fed chair. That's after a Wall Street Journal report that the president could make a pick soon. But there's been no let-up in the President Trump's pressure for rate cuts.
And if we had a person over at the Fed that would lower interest rates a little bit, that would be helpful, too. It's hard to believe. This is on top of, we have to fight this guy. He's not doing the job. Each point that he keeps it up is the equivalent of $300 billion. $300 billion. So if he lowered it to, it would save $600 billion.
To help us make sense of all this, we have MLive strategist Mark Cranfield in the house. So there's a lot going on. I mean, this week we've been seeing the Fed independence question marks, playing out again, almost overshadowing some of the data we've been getting out of the U.S. We've seen how the dollar is the cleanest expression of all those concerns. What are you watching?
Yeah, I think that you've got to have sympathy with investors at the moment when you hear all these potential deals coming on and the criticism of the Fed and not a lot of detail around it. You can begin to say, well, how do you make investment decisions on this? But the common denominator, particularly for macro people, is they look at the way the United States is forming policy and they're just losing confidence in the outlook. So they're looking for alternatives. And the thing is that in currency markets, there's always a two-sided action. You've got your base currency, which is mostly the US dollar, but you need something on the other side. When it comes together that you have a positive story somewhere else and a negative story for the US dollar, that is the time when things really get going. And you're seeing it this week with the euro. So the euro is taking the front line here. We've seen very significant moves already. We touched 117 overnight, and now people are talking about 120. And it's easy to see where they're getting that from. If you look what's happened in the option space this week, we've had a couple of spectacular days in euro trading options. 4 times the volume of euro options compared to the yen. And the yen is the #2 currency in the options space. We don't usually get a differential of that kind of magnitude. 2 days in a row on very significant volumes and big moves for the euro. That's telling you a lot of new money is moving into the euro positively. People are looking for much higher levels and with very substantial flows backing it up. That's why people are thinking that 120 is the next big benchmark for the euro. It's got quite a bit of work to do to get there. But what you're getting is a situation where people are more constructive on the European story. They've agreed to spend more money on defence and other areas. Germany is already busting its fiscal spending to improve conditions there. And then on the flip side, you've got conditions like people worried about lower interest rates because the pressure is coming from outside the Fed. But the market is responding by pushing yields down. That's negative for the US dollar. So it's almost like a win-win for the euro. And that is rare for it to come together so easily like that. And it's probably not the end of the story, and it's helping Asian currencies and other major currencies as well.
Okay, you talked about US yields there. Next week, we have an employment report coming up. The key one to watch is the jobless rate. What are you looking at in terms of, does all this Fed rumbling kind of overshadow the data at the end of the day? Does that affect what we see in July?
It's a part of the story. I'm not sure. The Fed thing isn't going to go away. They don't meet until the end of the month. There's going to be a lot of Fed speakers in the meantime. I'm sure President Trump will have more to say as well. Traders will also next week will be looking at the deadline for this tax and spending bill. It's a very big bill the United States is trying to push through. They really need it to go through by Independence Day at the end of next week. Otherwise, it could be delayed for a long period. So there's going to be a lot of tension around that. We'll probably be getting updates every day how that's going. That will add to the nervousness in the market as well. And then people also will be looking ahead to the week after, July the 9th, when supposedly some of these tariff deadlines come off as well. Even aside from the data coming in, there's a lot of other things to make people nervous. And you've got the US equity market near record highs at the same time. Chances of something to go wrong? Pretty high next week.
Yeah, okay, that's going to be keeping us on our toes, Mark. But just wanted to, ask you finally as well, when it comes to the steepening trend we're seeing in US Treasuries, that probably isn't helpful for Japan. But it's interesting, today we also got some data points that were softer than expected.
They were. The Tokyo CPI numbers came in slightly below forecast, still above 3%. Historically, that's pretty high. We're at levels that we were about 2 years ago in Japan as well, not coming down very much. But there'll be some relief there in Japan because rice prices especially have been so high, causing a lot of concern, especially for tourists who are thinking of going to Japan. But the Bank of Japan's got other things to worry about as well. Even though the Ministry of Finance has agreed to reduce the auction sizes for long-term bonds, we have a 30-year, we have a 10 and a 30-year auction next week. It's not going to be easy because the steepening is coming from the US Treasury curve and the German curve as well. That reinforces the signals into Japan. So they're bringing the 30-year auction at a difficult time. Not only that, yields have dipped a bit since the Ministry of Finance started talking. So we've got yields at slightly unattractive levels, not much relative value, a tough 30-year auction to come in a busy week as well. Might not be that easy.
Maybe we should take next week off, Mark. Thanks so much for sharing your analysis with us, Bloomberg MLive strategist Mark Cranfield. Always great to chat. Now let's take a look at the Taiwan dollar as well real quickly because it's been rallying past 29 level against the US dollar. This is for the first time since 2022. And of course, we've been seeing how the rally earlier in the year really took investors and, that generational move in the Taiwan dollar certainly kept investors, particularly Taiwanese life insurers, on their toes. We're going to be following on from that story a little later in the program. Plenty more ahead. This is Bloomberg. Let's take a look at the Taiwan dollar. We've seen that red hit crossing the terminal past couple of minutes or so after it rallied past 29 to the USD for the first time since 2022. And of course, this is against the backdrop of the continued slide in the greenback against these concerns about the US exceptionalism that continues getting eroded. Of course, the massive spike that we saw in the Taiwan dollar not so long ago really caught investors by surprise. Again, 29 against the greenback is where we're seeing Taiwan dollar. Aside from that, keeping tabs on what investors in Hong Kong are watching out for. A new survey from digital wealth platform Endowus has found that many investors in Hong Kong and Singapore have been making frequent changes to their portfolios, some as often as several times a month. Joining us now is Steffanie Yuen, Endowus Hong Kong head. Steffanie, really good to get your insights. But first off, tell us how you've been seeing Hong Kong investors sort of shift their portfolios, maybe any behavioral changes amid the ructions in the market in the past couple of months.
Thanks for having me. Yes, obviously we're now 2 days away, a few days away from the mid-mark of 2025. And certainly we feel like we've gone through a lot, right? Investors really, starting from the tariffs that President Trump announced on Liberation Day, April 2nd, have been through a roller coaster. So we've seen a lot of client inquiries in terms of how they should position their portfolios. And as financial advisor, we continue to tell clients and advise them that they should avoid short-term knee-jerk reactions. And if we zoom out a little bit as we now cross the mid-year mark, interestingly, actually, if you look at global markets, we're basically either up or back to where we started in the year. So if clients sort of had these knee-jerk reactions, given the sort of news flow that continues to come out, you might have sort of realized unintentional losses, short-term losses, and completely caught off guard and not be able to catch back up on the rebound. So at Endowus, we continue to advise clients to stay diversified, review their investment goals to make sure that their portfolios are really aligned with their long-term and medium-term goals, and make sure that they have enough liquidity to make sure that they don't get caught off guard with these short-term reactions, but don't get too caught up into the noise.
What about when it comes to expectations that we see rate cuts in Hong Kong? I mean, I get your point about not getting too caught up in the noise, but there's some anticipation of that, given what the Fed could potentially do.
Yes. So going back to the report, we just released this 2025 additional report. And this year particularly, we're interested to really understand what are the investment objectives of investors in Singapore and Hong Kong and their investment behavior, as well as how they view their relationship with their client advisors. And something very interesting came out is that we realized while a lot of investors say their investment goals are of longer-term nature, such as preparing for retirement, when it comes to their investment behavior or making investment decisions, they tend to be very sort of impacted by short-term noise, such as recent market performance, recent market trends. And so it's very interesting, and we titled the report Mind the Gap, that there is this gap in terms of how clients are thinking about their objectives versus their actual kind of behavior. And it's almost like if clients tell us they want to stay healthy, stay slim, but they continuously eat junk food. So I think going back to the role of the advisor, it's important for us as advisor to keep clients updated. As April, you mentioned, there's a lot of news flow, short-term news flow, truth social posts from the president. But how does that really impact clients' objectives in the short term, medium term, longer term? I think that's really important as a client advisor to be aligned to clients' investment goals instead of kind of just advising clients to mindlessly kind of make trades, which unfortunately in this part of the world, because our wealth model, a part of it is still commission driven, it tends to incentivize clients to churn and overtrade. But actually there are sort of downsides to that. If you trade too much, there are costs, and you might also make the wrong decision. So it's very interesting what we've seen in this report in the edition of this year.
Have you seen more stronger investor behaviour when it comes to reacting to the trailing of HIBOR, to US rates, to the currency weakness that we see in Hong Kong?
So it's very interesting. You look at the VIX, which is generally how we think about volatility, right? VIX really spiked up a lot in early April, but it has then trended down. Even with the recent Iran-Israel conflict, we have not seen VIX kind of shot up the way it shot up in April. And even with oil price, we only saw a very short interim spike. So I think investors now, and I've heard a lot of guests also share on the program that The only uncertainty is uncertainty. So including ourselves, we advise our clients, and I think clients are really understanding the importance to stay diversified, to review their portfolios, that making sure that it's resilient. And particularly in Hong Kong, I think recently, and we mentioned this earlier, right? The sort of drop of the HIBOR was quite dramatic. So a lot of clients are also, particularly on the shorter term liquidity goals, are reviewing whether they should park their deposits into Hong Kong dollar, which is giving them very low yields, potentially swapping over to US dollars. And I think these are some of the more constructive advice that advisors can give to clients instead of kind of knee-jerk reaction to, oh, there is a missile strike, you should immediately dump certain stocks, etc.
Steffanie, really interesting insight. Steffanie Yuen, who's ahead of Hong Kong at Endowus. Plenty more ahead. This is Bloomberg. Former Deputy PBOC Governor Zhu Min has said China's AI advancements are about to unleash a wave of more than 100 DeepSeek-like breakthroughs in the coming 18 months. Our chief North Asia correspondent Stephen Ingles gives us a closer look at the country's progress when it comes to humanoid robotics, also known as embodied or physical AI.
Embodied AI is all the rage in China, from industrial automation to autonomous EVs, from delivery drones to increasingly advanced robotic humanoids and pets. AI is on board, and with their sensors, motors, and natural language processing, now they're interacting with us and the rest of the physical world, and it's arriving in much more lifelike packaging, as creepy as that may be. China's Ministry of Industry and Information Technology says China since last year has produced nearly 100 embodied AI robotic products, claiming the country holds 70% of the global market, due largely to its unrivaled stem-to-stern supply chain of critical parts and advancements in its own AI and chips. The embodiment, if you will, of China's DeepSeek moment.
I think that ushered in a whole corporate culture where we're trying many Gen AI use cases. We have also labs and PhDs who are working on these things. When would this ever impact the bottom line or have real impact? I think that's the question.
We do know that the central government has put out a venture fund tapping about $138 billion for the development of humanoid robots for industry and for personal use. That is a lot of money and probably just the tip of the iceberg. In an otherwise difficult job market in China, online recruitment firm Zhaopin says the number of job openings in China's humanoid robotics sector has quadrupled so far this year from last, with salaries for the needed algorithm engineers rising well past the average urban pay. Hangzhou-based Unitree is one of the pioneers of consumer robotics in China, offering its latest so-called humanoid agent AI avatar, the 4-foot, 2-inch, 77-pound G1, on the web for $16,000. He can do all kinds of things. He can run, he can jump, he can get you coffee. Or for $1,600, there's the 4D ultra-wide recognition LiDAR-equipped Go-To dog, with plenty of tricks up its 12 flexible knee joint motors.
It can stand. It's just the beginning stage.
For China's vast industrial complex as well, rapid automation includes the increasing use of inspection and diagnostic bots with embodied AI, such as Lenovo's six-legged Daystar, deployed in places unreachable by or unsafe for humans.
I think the Chinese robots will come into the world, in a way that as a price for money and price of value, that will be quite unbeatable.
With the backing of state policy and funds, expect a myriad of new embodied AI products to try and grab your attention. Like it or not, we may be staring directly into the future. Stephen Ingles, Bloomberg News, Shanghai.
Let's take a look at how markets in Asia are faring as well. The Asia-Pacific region's benchmark looking a bit green as the geopolitical tensions ease the backdrop. Investors focusing more about the prospects of rate cuts to come. This is Bloomberg. It's 11:29 a.m. in Tokyo. Japanese markets going on break in a minute, and the SoftBank AGM is underway with CEO Masayoshi Son speaking to shareholders. And it's interesting, he has highlighted that he has in mind successor candidates within SoftBank, but that he still sees himself as sort of healthy and passionate about the artificial super intelligence trend for the next 10 years. And of course, that SoftBank is indeed planning to be the world's #1 platform when it comes to ASI. And of course, he also spoke about how OpenAI, some of SoftBank's key partners in this endeavor are indispensable for the coming ASI age. We're seeing the shares of SoftBank extending some of the gains following these comments from Masayoshi Son. Just a quick look as well on Japanese benchmarks. We did get the Nikkei topping 40,000 for the first time since January, but this was also against the backdrop of some softer than expected data, including Tokyo inflation, which is, of course, a leading indicator for nationwide trends. Heidi.
We're also watching inflation data really globally, but of course, particularly out of the US, with the Fed's preferred gauge of underlying inflation due out later on Friday. And economists, this is their view. They see the core PCE price index rising just 0.1% in May. That would complete the tamest 3-month stretch for the gauge since the pandemic 5 years ago. Our next guest tracks online prices to come up with statistics on inflation. Let's bring in now Alberto Cavallo, who's a co-founder of PriceStats. He's also an academic partner at State Street Associates and Professor of Business Administration at Harvard Business School. Bertie, really great to have you with us. And of course, there's a lot of sort of externalities in terms of that inflation outlook. The geopolitical and oil situation seems to have calmed somewhat in terms of volatility, but there's still a great deal of uncertainty when it comes to trade, tariffs, and how that's going to feed through to price pressures. Is this sort of the calm before the storm? Is the Fed right to be cautious at this point, because we don't know what the next 6 to 12 months of pass-through is going to look like?
Yeah, there's a tremendous amount of uncertainty about the level of inflation in the U.S., but our indicators suggest that it is quite under control at the time. We are seeing some pockets of pressure from the tariffs impacting a few categories, particularly those that have a high share of Chinese imports, but the magnitudes are still not significant enough to affect aggregate statistics. And we have some categories, such as fuel, for example, that have been pushing prices down and compensated for some of these upward pressures. So overall, I believe the official numbers are likely to show stable inflation rates in the next few months, at least in the short run. And of course, there's a tremendous amount of uncertainty about what will happen, particularly now with the geopolitics and the potential fuel pressures. So it makes sense for the Fed to be cautious still with its decisions.
Well, the other thing is, I do wonder whether many companies, with the onset of the tariff shock or the trade war threat, have already made those decisions when it comes to spending, when it comes to price rises, and how that's going to feed into broader confidence. Is that sort of sentiment hard to undo, even if there is an alleviation of actual tariff pressures?
Yes, I think many firms are wondering what to do with the tariff, but you have to remember they just don't know how large those tariffs will end up being. There's uncertainty, about the fact that they've been raised, lowered, and firms do have a lot of ways to adjust in the short run. We've seen evidence of that in the U.S. Many of them were front-loading their inventories. They were trying to do trade diversion. They tried to soften the blow as much as they can. And in the context where they don't even know where the tariffs will end up stabilizing, they just delay many pricing decisions. So even though there may be some pressure building up, my sense is it will be very gradually passed onto prices. We won't see that magnitude of pass-through that we call it, how much it affects consumer prices increasing all of a sudden. It will be a very gradual process. And it's not happening in isolation. It's happening at the same time with fears about aggregate demand in the economy, and that actually, to the extent that the economy slows down, that could potentially even put downward pressure on prices. So we're at a stage of a lot of uncertainty. There's no indication of an acceleration, but we need to keep an eye closely on what is happening, particularly with the energy sector, which is one that tends to drive a lot of volatility in inflation.
What about when it comes to consumer behavior towards goods that have exposure to China? Does that sort of differ when it comes to whether they're durable or non-durable goods?
So usually durable goods consumption is something you can delay, but it obviously depends on what has happened to the prices of those goods, whether they've gone up or not. There's a couple of places where we find evidence of rising price pressures, and that's exactly in some durables, things like furniture, for example, also some household goods, and some electronics have faced some quick reactions to news. My research, I show that prices have been responsive to news about tariffs, but many retailers are not increasing those prices dramatically up to now. And as I mentioned, because of all these ways they can adjust, the fact that there's tremendous uncertainty. So consumers in the U.S. are still probably not noticing significant increases on average, even in these categories.
Even if they don't sort of notice it now, though, that doesn't really mean that, towards the later part of the year, especially when we get a better sense next month or the month after that, what the U.S. is going to be pushing through when it comes to tariffs with not just China, but other Asian economies as well. Does that then potentially provide another risk to higher prices for goods?
Yeah, if there were to be some certainty about the levels, and imagine those tariffs are high, then it's likely to start having more pressure on those goods, upward pressure, and consumers may start to notice. But it's early to tell. I think most important than just thinking of the tariff shock in isolation is to consider it in combination with what is happening in sectors like fuel. The recent geopolitical pressures that have happened threatened to increase the price of oil, and we've seen about a 1% increase in the price of fuel in the U.S. Since June 13th. This is, in terms of magnitude, again, not large enough to cause any significant effects on the aggregate index, but it's where we should be placing our attention if we want to understand what may happen with inflation.
I need to ask about Japan, obviously the outlier when it comes to the inflation picture. You said that your data had detected a slowdown in price pressures in May, and that was really reflected by the Tokyo CPI data. Do you think it's meaningful? Is it more sort of a base effect, and does it really change the correct approach when it comes to the Bank of Japan?
So just to be clear, since 2021, our data and also the CPI has detected higher inflation levels in Japan. The long-term trend has actually been quite stable at around 2.5%. So I think that's actually a healthy level of inflation on average for Japan, particularly compared to previous years when it was so hard to bring that number up. But it's true, in the last month or a month and a half, we have detected a slowdown. The CPI has, I think, not yet fully reflected that at the country level, but we don't know how long this will last, this slowdown. We have seen it, for example, before, most prominently at the beginning of 2024. My sense, though, in terms of policy effects, is that this will give room to the Bank of Japan to wait a bit longer before raising rates any further. The data is softer, I think, than what the CPI is so far reflecting. And that will give it some time and to delay some of those discussions, at least, about tax hikes that we were seeing in the last month or so.
Yeah, we've certainly been seeing the BOJ policymakers taking a sort of wait-and-see approach, especially when it comes to messaging of the rate path ahead. Alberto Cavallo, thanks so much. He's PriceStats co-founder and State Street Associates academic partner. Subscribers can watch us live and see our past interviews on our interactive TV function, TV Go. You can also dive into any of the securities or Bloomberg functions we talk about and become part of the conversation by sending us instant messages. Check it out at TV Go. Plenty more ahead. This is Bloomberg.
Welcome back. Let's get more on one of our top stories today. And Hong Kong builder New World Development has secured written commitments from all banks involved in its $11 billion loan refinancing. The deal would push back borrowings worth around $9 billion due this year and next and extend the maturities for 3 years. But strains still remain, especially regarding a loan backed by its key asset, Victoria Dockside. Well, with New World being the most indebted of Hong Kong's big developers, our team at Bloomberg Originals has been looking into the roots of the company's crisis and how it's struggling to find a lender to nurse it back to health.
In China, there is an ancient proverb, 富不過三代, meaning that wealth doesn't pass 3 generations. For years, it serves as a cautionary tale of how difficult it is sometimes for wealth to pass beyond generations.
In Hong Kong, 4 dynasties dominate the property sector, each worth tens of billions of dollars.
Property is the religion of Hong Kong.
But now, one of these seemingly untouchable dynasties is in crisis.
Hong Kong developer New World jolts creditors by delaying bond payment.
They've had 2 different CEOs in the last couple of months. There's a succession issue here.
Adrian stepping down was shocking because in traditional Hong Kong tycoon families, family members are very important, and the eldest son is the most important member of all the children.
Over the last decade, heir apparent Adrian Cheng played a pivotal role in rapidly expanding New World's properties, and in the process, racked up billions of dollars of debt. A string of recent misfortunes, some within the company's control and some not, have hit New World's share price hard. Now it's working to refinance about $11 billion of debt. At the centre is a Hong Kong dynasty uncertain about its future, trying to navigate China's ongoing property crisis. In Hong Kong, 45-year-old Adrian Cheng is a celebrity.
If you go to Adrian's Instagram account, you could see photos of him with pop stars like Blackpink members and even with the French President Macron.
Educated at Harvard, he's a prominent figure in the art and culture scene.
He incorporated a lot of artworks into his developments, including residential developments and a lot of luxury shopping malls.
That can be seen here on the Victoria Harbour waterfront at the K11 Museum Mall. And not just seen.
The first thing you notice is the smell. And that smell is kind of sweet. And as I know, this very smell is created by Adrian himself.
It took Cheng 10 years, a whole lot of perfume, and $2.6 billion to bring the project together. But the art mall is just the tip of the spending iceberg.
He acquired an insurance business and he invested in healthcare, and he also really doubled down on retail.
We have spent over $30 billion in acquiring 1.5 million square meter of land. And a lot of people will ask me, why will you be putting so much eggs in Greater Bay? It's 5% of China's population, but 13% of the GDP of China.
New World Development is a sprawling company with commercial and residential projects across Hong Kong and mainland China, which the company says are worth $54 billion US. And all that property comes with massive debts. New World borrowed big in the late 2010s. But at the time, investors cheered Cheng on. The company's share price climbed. It looked like a continuation of the Cheng family's successes, which began with Adrian's late grandfather. Cheng Yu-tong fled from Guangdong in southern China during World War II and arrived in Hong Kong in 1945, working at a gold store called Chow Tai Fook.
The gold shop became very successful because of the population boom. With the capital from the gold shop, Zeng went into real estate.
The 70s and 80s were boom years for Hong Kong's property magnates. Fast forward to the 2010s, and Adrian began to take control of New World development. He felt the company needed a makeover.
New World at the time became a more high-end brand that really catered and appealed to the more sophisticated middle class who wanted their real estate or wanted their homes to look more different, more high class, and that really succeeded.
But the party couldn't last forever. Hong Kong's fortunes were about to take a turn. Protests over the increasing influence of Beijing on the city began in March 2019. That June, an estimated 2 million people took to the streets to oppose the direction of the Hong Kong government. Police and security services cracked down.
China introduced a very controversial national security law in Hong Kong, and that had an impact on Hong Kong's reputation.
Then, in a double punch to confidence, COVID struck. Hong Kong locked down, global business slowed.
Hong Kong's economy was battered, and even after COVID, Hong Kong's economy was finding it hard to recover. Tourists are not coming back as much as before.
Zeng's luxury vision was facing the harsh reality of a changed and diminished Hong Kong. And all that debt, well, it started to become a problem. Look at this red line. New World's debt reached 95% of its equity at the end of 2024, well ahead of its competitors.
And it was around that time when people started to realize that, hang on, New World's expansion plan, dated back in 2017 and 2018, might have contributed to this heavy debt level.
The market woke up to just how bad the situation was looking at New World. The company's bonds, debt which they sell to the market, plummeted in price. Investors figured they were unlikely to get all their money back. Zeng's father, who was New World's chairman, stepped back into the spotlight. In a rare interview on local Hong Kong TV, he suggested the previously unthinkable. Adrian might not be the one to take over the family business.
揾呢個人呢，唔係易揾。如果揾到呢，我就非常之高興嘅。
Adrian Zeng was widely expected to be the successor of the whole family group. And then news came that Adrian would step down as CEO in New World after, leading the group into its first losses in 2 decades.
People were like, oh my God. When you say New World, people think of Adrian Cheng and vice versa. That had lasted for more than a decade.
Adrian Cheng's investments, at first seen by analysts and investors as innovative, were now being judged as overextending New World.
At the time, everyone was praising Adrian. And then now, in hindsight, everyone is saying, oh, of course, he shouldn't have.
Adrian's position as heir apparent is now in question. His 3 other siblings have taken up key roles across the family business, none more prominent than his younger sister, Sonia Cheng. She runs the family's original jewelry empire and the hospitality side of the company, including the Carlyle in New York and the Hotel de Crillon in Paris. With Henry back at the helm, he and the new CEO will need to nurse the company back to financial health as China's property crisis drags on.
China right now is experiencing an economic slowdown because of all the trade tensions and its own economic issue, including a real estate slump and very high youth unemployment rate.
New World's debt-fueled expansion is now a warning to Hong Kong's other property tycoons, and a reminder that keeping business in the family has its challenges. According to a 2024 UBS study, about half of family businesses in Asia will change hands over the next 5 years. That's over $1 trillion in company value, moving generations.
New World's Zeng family is really one of the first Hong Kong tycoon families that are handing the businesses to the 3rd generation. We're talking about billions of dollars being handed to the 3rd generation. So for other tycoon families whose businesses are now still very much in control of the 2nd generation, they will be looking closely at what's happening in the Zeng family.
Subscribers can rewatch our weekly documentaries anytime on the terminal, and they're also on the Bloomberg Originals channel on YouTube, and you can get an insider's guide as well to the money and people shaking up the finance hub in our Hong Kong edition newsletter. That's out every Thursday. You can sign up via bloomberg.com/newsletters. Plenty more ahead. This is Bloomberg. Some of the stocks we've been focusing on for the session today include Xiaomi, which touched a fresh intraday record high after surging about 8%, following on a really strong upbeat orders from the release of its new SUV. Those pre-orders surging past 200,000 within the first hour, and just really speaking to its ability potentially to gain a foothold when it comes to the EV markets. But aside from that, we're also seeing some of its peers, interestingly, also falling in Hong Kong trade today, including the likes of XPeng, keeping watch on some of these copper stocks as well. We are monitoring a major supply squeeze on the London Metal Exchange, and prices actually rose on copper for a 6th day as spot premium surged. And this is due to, in part, plunging exchange inventories. So some of these copper-related stocks also climbing in trade. Heidi.
Ava, we're watching Nike suppliers here in Asia and some of those peers as well as we see that rise. It was an optimistic sales outlook. Still some downside to come, but it does look like the leadership's sort of turnaround plan is starting to take effect. They're predicting that the sales slump has kind of, at least for now, bottomed out. So we're seeing some nice gains across the board when it comes to the Asian suppliers and some of those related stocks as well. Nike shares had jumped 11% in the US session in aftermarket trading. They are expecting sales to fall by mid-single digits in the current quarter. That's better than analyst estimates, and certainly an improvement over the 11% drop from that latest period there as well. The other stock that we're watching at the moment is Korea Zinc, where we're seeing a move of close to 11%. They're set to appeal the ruling over the invalidation of their new share sale, and that will happen in a court ruling after losing to Yangpyeong in that lawsuit. That is it for the China Show. Insight is next. This is Bloomberg.